Welcome back to the channel, everyone. I'm Skylar James, and today I am filming from the beautiful agricultural neighborhood of Lania Poco. I am choosing to film here today because we're going to be talking about farms and rich people like Bill Gates investing in farms. So Bill Gates owns more farmland in this country than anyone else. You might be asking, shouldn't you be a farmer to own a farm? It's a great question, and the answer is no. You can choose to invest just like Bill and act as a landlord to farmers. In fact, when you include cash rent yields, American farmland has appreciated in value every single year since 1991 and at a whopping rate of 11.5%. Not only is this a growth play in more ways than one, but it also comes with dividends, making this stable investment like gold bullion with yield. Today, we're going to look at why farmland is such a great investment and how to do it. The human population grows by 6 figures a day. You'll hear this theme a lot in my videos. I like to ask the question, what do all these new people need? And depending on the answer, there's usually a good investing angle. Today's angle on population growth is farmland. You already know what farms do, but maybe you're thinking, why should I invest in it? It's simple, good old-fashioned supply and demand. We know that old saying, buy land because they're not making any more of it. Well, it's true. There's a fixed supply of land, and more specifically, there's a fixed supply of farmland. There's an important distinction there because not all land is suitable for farming. Think about the frozen tundra in Siberia or rocky peaks in Colorado. These aren't places to grow corn or apples, which brings us to point number 2. Farmland as a specific type of land is actually shrinking. It's happening for several reasons. Inefficient farming practices, erosion, overgrazing, but from an investment perspective, what's most important to us is that supply is shrinking. People are still born each day, and they still require food. There is a need, a demand for productive farms, and they need to eat every day, 3 times a day. As an investment, farmland appreciates like gold, but it has yield in that it generates revenue. Owning and leasing out farmland cuts you in on the farm's productivity. You, as the landlord, receive rent in the form of dividends. So not only is there a fixed supply of farmland, but actually a dwindling supply, coupled with a steady increase in demand every day, 3 times a day. And that's part 1. That's the why of holding farmland as an investment. Part 2 is the how. How can I invest in farmland? There are 3 different ways. 2 I don't like, and 1 where the porridge is just right. The most traditional way to invest in farmland is to buy a physical farm. Quite literally, buy a farm as if you bought a house or a condo. Why isn't this a good fit for everybody? Well, for one, it's illiquid. Henry David Thoreau, the recluse from the 1800s, heard of that guy? He lived in a cabin cut off from all people, and even he had the investing sense not to take on a physical farm. Plus, buying just one farm isn't diverse, because with one farm, you're really going into one geography, one climate, one specific set of water risks. And usually, one farm grows one specific crop. And a farm requires a big piece of capital to purchase. Billionaire investors, well, they create diversity by owning dozens of farms in their massive real estate portfolios. Most of us aren't there financially just yet. The second way to invest in farmland is through investment funds only open to high net worth individuals and institutions. Now, some of you watching, no doubt, do qualify for these, but this means you're an accredited investor. Say that again, accredited investor in the SEC's eyes. Similarly, there are private REITs with minimum investments and long hold periods, like this Iroquois Valley Investment Trust. But we can do better than that. That porridge is still a little too warm. How? Well, it's with publicly traded farmland REITs, real estate investment trusts. REITs, as many of you already know, are companies that exist to hold real estate, then pay out their dividends or profits to investors. Currently, there are only 2 publicly traded farmland REITs, Farmland Partners and Gladstone Land, tickers FPI and LAND, respectively. These specialized REITs hold a diverse portfolio of farmland made up of different crops and different geographies across the United States. Interesting REIT side fact, in the whole of US REITs, these 2 farmland plays together only equal 0.1% of the iShares US REIT ETF. By owning that Big Daddy ETF, you aren't really getting much exposure to the promised yields and outperformance of farmland. Looking at these charts, we can see the stock price of these farm REITs has run up in the last few months. These prices more or less trace commodity pricing's equally impressive rise. This is a common correlation between these two. At a market cap of under 400 million for FPI, I recognize it, and Gladstone Land for that matter, as a microcap investment. These will tend to be riskier and possibly a little more volatile. I'm not dismissive, just cautious, and want to highlight those traits. So what does FPI hold? They have an array of farms stretched across the country. That's the diversity we identified a few minutes ago as vital for making farmland work as an investment. Gladstone, similarly, has a variety of farms in its portfolio. Different crops, different states, highly diverse. When researching REITs, I'm normally asking a few questions. What's the gist of the properties in play? Is this sector growing in importance or shrinking? And what's the yield? Farmland REITs are not that simple. A farm on one side of the road might have soil strong enough to grow blueberries that can generate $35,000 an acre upon harvest. The farm across the street might only be able to grow potatoes at $500 an acre. I'm not making this up. This actually does happen. As investors, buying into these farmland REITs requires a certain trust that the portfolio managers are doing their due diligence. For example, check out this property in the Farmland Partners portfolio. I randomly chose this Fresno, California area farm from the property list. It's a 3-piece lot. The biggest piece is on Floral Avenue. Farm has almost 500 total acres. Okay. 40% of the acreage is Hanford sandy loam and 26% Delhi loamy sand. Does that mean anything to you? Probably not. You need to be an agronomist to figure these things out. These are both types of soil, by the way, loamy sand and sandy loam, each with specific properties that determine which crop is the best fit. So farmland REITs are not as simple as a warehouse REIT. I think with FPI and LAND, I trust management with their acquisitions and trust the larger farm scarcity theme. Gladstone has 100,000 acres in its catalog. Farmland Partners has 150,000. Both have shown they will acquire new properties as opportunities arise. Each of these REITs pay a humble dividend, 1.7% for FPI and 2.7% for LAND, but I think the value of the underlying real estate will rise faster than other REITs, just as it's been doing for decades. In the time it took for you to watch this video, we lost 70 hectares of farmland and added 1,300 people to our population. Preserving farmland will be vital to keeping all these people healthy and fed. And that's why I think Farmland Partners and Gladstone Land are 2 companies worth investing in. Thank you for watching.